I am here today and pleased to introduce Pete Wirtala. Pete is our insurance specialist. He has been with the company for the last 18 years as well. And he will be giving his perspective on the current equity market and how insurers should navigate the volatility that comes with the sector. So with that, please welcome me in joining Pete, or join me in welcoming Pete. Sorry about that.
Hello. She said I'm Pete Wirtala. I'm insurance strategist and a principal at AAM, and I have spent the better part of my career thinking about how insurers invest, and the worst part of my career trying to get bulleted lists to align properly in PowerPoint. See the fruit of both of those efforts today. Today we're going to be talking about equity, specifically how to think about equity in a market environment that frankly looks almost nothing like it did just 5 or 6 short years ago. The subtitle of this presentation is Managing Volatility in a Shifting Market. Now, I am a huge believer in the critical importance of diversification. I originally was going to have a subtitle of just Diversifying Equity Investments, but we determined that the acronym for that might cause some confusion of what meaning of the word equity we're dealing with here. So here's the thing. Equity is not it's not a sideshow in insurer portfolios, particularly on the P&C and health sides, but also to a significant extent for life companies. It is a core foundational asset. It's a major driver of returns, and more importantly, it is a major driver of volatility in investment results. So whether you love equity or merely tolerate it, you need a strategy, and that is what we're here to talk about today. So we're going to cover 3 areas. First, we're going to ground ourselves in why equity matters for insurers. Have a few interesting data points there. I think we hear a lot about newer or flashier asset classes. We hear a lot about private equity or private credit, and for good reason. But equity remains a compelling pillar of insurer portfolios, and we'll get into why. Second, we're going to take an honest look at the current equity landscape, at valuations, returns, concentration, and what all of that is going to mean going forward. And third, the part that you will hopefully be able to actually take home and use, we're going to walk through some practical equity strategies, how to size your equity allocation, what kinds of vehicles you should be holding it in, how to deal with the concentration risk we're seeing, and ultimately how to keep all of this disciplined through an effective rebalancing policy. So let's go ahead with that. All right, to start with, here are 3 numbers to frame our whole conversation going forward. First of these is 21%. That is the average equity allocation of P&C insurers as a percent of invested assets as of the end of last year. That might not sound too dramatic, but bear in mind that back in 2010, that number was about 12%. So in 15 years, the industry has nearly doubled its total equity exposure, its relative equity exposure as a percent of investments. Now, the insurance industry tends to move very slowly in changing asset allocations, minor fluctuations from year to year. So a change of that shift is actually very dramatic. There's a lot of reasons why. Bond yields spent much of that decade at pretty low levels, and insurers needed something to generate returns above their cost of capital. Equity is really what filled that gap. I'm going to interject real quick, too. A lot of what I'm going to say here, that was a P&C industry statistic. Equity is certainly, it's the most widely held asset outside of IG bonds for P&C companies and for health companies. It is less commonly held for life companies, though it is still relevant there as well. I actually saw a statistic the other day that among life companies under 500 million in assets, they actually outperformed larger life companies in total investment returns last year, despite all of the fancy and sophisticated private credit strategies those large life insurers have, just because smaller life companies have more equity, and it did so incredibly well. Now, they took a lot more risk in having more equity, too, so there's that to it as well, but I'm just saying that it's not an irrelevant story in the life side as well, even though they're not as major of holders over there. Anyway, second number here. 73%, that is the share of P&C companies with assets over 20 million who own equity in some form. So this is not a niche strategy by any means. This is basically a core strategy. Nearly 3/4 of the industry is in the market, and this spans the full spectrum. This includes small mutual companies with maybe just a few simple ETFs, to large commercial carriers who might have multiple actively managed strategies running in tandem. The third number is 23.1. That is the 25-year correlation between the Bloomberg Aggregate Bond Index, basically just the whole US bond market, and the Russell 3000, basically the whole US stock market. Just 23% correlation. And as we all mostly live in a world of bond portfolios, I mean, this is the number that should get your attention. A 23% correlation means that you're getting genuine, real diversification against your core fixed income book. Notoriously, a portfolio that is 95% bonds and 5% equity actually has a lower long-term average volatility than 100% bonds. And in a world then where duration risk and credit risk can in some cases seem like they're ganging up on you, this is a benefit that's real and valuable. And the benefit of these two assets working together, we've seen many examples even in recent history when that came through. In Q1 of 2020, when COVID hit, obviously equities were selling off severely back then. The Bloomberg aggregate was up 3%. So just having, and that's really the name, that's what diversification looks like. One thing is up, another thing is down. If all of your assets are rallying at the same time, that means you're probably going to have a day when you see the reverse happen. But a nice smooth, even curve is what we hope for with good diversification. Now, one thing I should note, and anytime I'm talking about total industry exposure to equity, I saw a fascinating statistic the other day that of all the equities held by P&C companies, 57% are owned by Berkshire entities in one way or another. They are a statistical outlier to say the least. But the trend of broadly rising exposure is legitimate even if you strip them out. And certainly it is still a very widely held asset. Again, that's 73% of companies having exposure there. So talking about the role that equity plays in portfolios. This had a lot of fun making this graph. This shows for individual P&C companies, and every dot here is a company, the correlation between their average exposure to equity as a percent of investments and their 5-year total investment return, including income and both realized and unrealized capital gains. And what you see here is a 70% correlation. In presentations like this one for years, I've been saying that as a P&C investor, the amount you put into equity is arguably the largest long-term driver of risk and return. It occurred to me I should probably actually investigate if that statement is true. And I gathered this data, and it's a fairly compelling case, I have to say. I don't know if it's the most important thing, but it's certainly up there. And what this tells us is natural and intuitive. Equity returns more than bonds over time. The more equity you hold, the higher you expect your returns to be. Before anyone gets too excited and goes back and says, Peter told me to put everything in stocks, it's the best asset to own. This shows returns, it's not risk-adjusted returns. These companies out showing 8 or 10% average returns per year have also had some very steep drawdowns in that time. They're taking on substantially more risk. The real question is not just about how high can you get your returns, but how much of an equity decline can your surplus absorb when things go wrong? We'll be talking about that a lot more a bit later. But equity is not again, it's not a sideshow. It is arguably the biggest lever you have for trying to increase investment returns. If you're a CFO, you see a book yield of 3.5% or 4% on your bond portfolio, you want to try to get that up to 5 or 6% a year. Equity is an excellent tool to have to get you there. You do also, though, need to be able to manage the risk that comes with it, and we will be talking a lot more about that. All right. So talking about historical returns to equity, very, very simple graph here with, I think, a profound message. This is the blue bar here is the average annual return on the S&P 500 from 1969 to 2019, so 50 years. That's right about 10%. And if you look at an asset allocation textbook or like a long-term capital market assumptions deck, you'll often see that 10% number as kind of the average long-term nominal pre-tax return on equity. And that's an accurate number. The gold bar is what we've had since then. That's from the end of 2019 up until May 31st of this year. That's 16%. So about 60% higher than that long-term historical return. And this obviously covers a period of over 5 years. This includes the 2020 COVID crash. It includes the 25% decline in 2022. It includes the tariff tantrum from last year, and even so, a 16% average annual increase. What does this mean? It means that the recent past has been exceptionally generous to equity holders. That's wonderful. It does also mean that anyone who now today is thinking about investment strategy looking forward and is kind of doing a linear projection of that recent performance into the future is probably setting themselves up for an elevated likelihood of being disappointed. I like to remind people the stock market is the only store where everything goes on sale and everyone runs out the door screaming. And the reverse of that is also true. It's the only store where the prices double and everyone lines up to buy more. The point of all of this commentary, though, is not to be bearish. It is to be realistic. Expecting 16% a year going forward is not perhaps a realistic plan. I would love to be back here 3 conferences from now, 6 years from now, eating that statement. You can all hold me to that. But we need a firm foundation for planning our strategy on, and expecting some degree of mean reversion is pragmatic. So Aaron Diefenthaler already mentioned how we've all read about this in the Wall Street Journal, and I could feel the wind going out of my sails. Like, great, this is my big exciting data point, and everyone already has had it beaten to death for them. But yes, this is a very important number because this is something truly unprecedented going on today. The level of concentration in major US equity indices. Right now, the top 10 stocks in the S&P 500 represent about 40% of the entire index. And ultimately, 3 stocks alone, NVIDIA, Apple, and Google, if you count the multiple kinds of Google shares, make up about 20% of the index, or a fifth. Meanwhile, 450 companies, many of which are very large, multi-billion-dollar established businesses, average about 13 basis points apiece. I'm sure you're all already done the math in your head. If it was all equal weighted, they would all be 20 basis points apiece. So basically, these 450 companies have about 2/3 of an equal weight share each. Now, it's not uncommon in specific small countries to have like one national champion company that's like half the stock market or whatever. The US, it's really never been that way. Actually, it's a quick exercise. Can anyone name for me a company or two that was in the top 5 market cap of the S&P 500 in 1995? Any guesses? GE was number 1, Exxon was number 2. The other 3 were Coca-Cola, AT&T, and Philip Morris. And in some sense, you could say it's a healthier economy. It's a more diversified top of your market, and these are different industries, and even the companies themselves are somewhat diversified. Though calling it healthier does feel a little bit awkward with Coca-Cola and Philip Morris in there. But part of the issue here is that it's not just a handful of companies taking up so much weight at the top, but they're basically all in closely related industries, and they've risen because they're tied to the same narrative. So the bottom line with that, though, as insurance investors, what we care about is that if you have just a passive S&P 500 or broad market index fund, it is not as diversified as it used to be, to a degree that's truly unprecedented in market history. To a significant extent, this is now a more concentrated bet on the AI theme and these mega cap companies that are heavily exposed to it. These are extremely solid companies. NVIDIA's margins are the stuff of dreams. Apple prints money like a central bank. The risk here is simply that someone might perceive themselves as being more diversified than they are, with the ground having shifted underneath them. And really just resolving any tension that might exist between that perception and the reality is what we care about. It might be perfectly reasonable for someone to say, these companies have run up a lot, but I think they're very strong companies, and my strategy is and has been passive exposure to the market, and if that has led to some concentration, then so be it. I'm not trying to take any active adjustments against that to correct that. That's a fair stance to take because it's an informed stance. But what we don't want is to anyone, again, think that they are as diversified as they were back in like 2021. So a next item here, and this has been touched on a few times, is the valuation landscape in equity. I was happy to see in the last presentation that like equity market valuations was a top 3 concern in the survey there. Basically, we're at record high valuations on every metric. The green line here is total US market cap to GDP. This is famously sometimes called the Buffett indicator. And we also show price to sales and price to book here, and you can see how high they've all gotten. Now, valuation measures are terrible short-term timing tools. One thing I'd point out here is you look at like 2019, where some of these measures were at. They were at a high level. Buffett indicator, was the highest it had been in many years. It was not that far below where it was in the tech bubble. And yet, you saw that 16% average return since then. If you had looked at the market then and said, this looks expensive, you missed out on a really fantastic run. And there's nothing to say that that won't happen for another year, another 5 years. We really don't know. A market that is expensive can get even more expensive for a long time. That said, valuations have historically been a pretty strong predictor of long-term returns. We're talking like 10 to 12-year returns. The Buffett indicator in particular, that's part of why it became famous, was that has often had like a 70 to 80% correlation with the subsequent 10-year return. Interestingly, that relationship has actually broken down a little bit over the last like 5 to 10 years. And the main reason I've seen cited for that is the Fed has become much more involved in trying to actively support markets when they decline. We've seen a lot of that in the post-GFC world. Whether or not that means that that's going to be a permanent feature and the downside risk has just been taken out, I would not want to bet on that. But that's the role that these valuation measures play. They give you a very long-term sense of what returns might look like, but they shouldn't be what drives your decision for today or tomorrow. To the point earlier, though, about the elevated equity returns, this is another signal saying don't necessarily expect the next decade to look like the last one did. Now, the natural pushback, though, on that valuation argument is, but Pete, companies are so profitable today. As you yourself said, look at companies like NVIDIA and Apple and Google. Look how much profit they're making. These valuations are justified. And there is some truth to that. This chart shows the S&P 500 profit margin going back to the early 90s. Current value there is about 12.6%, which is very near the high set back in 2013. The long run average here is more like 8%. So current margins are far above the historical average. And there's a lot that goes into that. One could argue that it's, we've arrived at some tech-enabled business models that enable just asset-light, strong returns to be perpetually driven, even having moats derived from things like network effects. One could also point out that for much of the time period shown here, interest rates have been declining, and there was a big decline in corporate tax rates in 2017 that probably had something to do with this as well. But ultimately, though, even these mega caps, while they do have some benefits that have caused them to grow to this size they're at, you have to look at also what they're doing now. They're making extensive capex. They're starting to look a lot more like auto companies or railroads in terms of their capex and fixed assets compared to the asset-light business models they've had. So definitely a lot of room for different opinions on this, but there is support in the data here just in terms of how much more profitable these companies have become over this time. Ultimately, though, and maybe some of you see this coming, I have to bring out probably the crustiest idiom in all of finance, that anyone saying this time is different. These are the four most expensive words in investing. In any case, even if you believe that margins stay elevated, maybe you think that it's going to be more like 10 to 11% as a new average plateau instead of historical 7 or 8%. Repricing to there would still be a significant decline from kind of what the market's priced for today. So the margin of safety at current valuations is, well, marginal. All right, next we're going to take a look at international markets. There's a few data points here that I think are very interesting. This compares 3 equity markets. Top row is the US, the S&P 500. Then there's the developed world ex-US, that's the EFA, and then emerging markets. We have a few statistics here. We have the long run average returns, and again, for the US, you see roughly that 10% number. For both of these international markets, performance significantly lagged during that 20-year period, like dramatically lagged. If you, skipping over that second column, if you look off to the right at how big drawdowns have been, we see that generally speaking, not only have these international markets had their worst drawdowns simultaneous with the US stock market, but they have been deeper. For a long time, it's been the case that if you held meaningful international equity exposure, you lost more in a sell-off and you did not get paid more when things were booming. It's been a tough market for these geographies. But if you look at that second column, starting from the end of 24 up until today, we see a pretty marked divergence going in the other direction. International performance in emerging markets has more than doubled what the US has returned, and it's not like the US wasn't trying in that period. There's a few things going on here. There's been some changes in valuation of the dollar internationally. There's been significant fiscal and monetary stimulus in some international economies. Certainly the effect of tariffs last year caused a lot of capital to move away from the US into some of these other markets. So there's multiple stories going on in different parts of the world that have led to this overall effect. But certainly one thing that supports it all is that these are also markets that are priced at much more reasonable valuations than the US. These are typically, they have price to sales ratios more like kind of 1.8 to 2 versus I want to say 3.7 was what I saw just a couple weeks ago in the US. So the valuation argument I think is definitely one thing, as people see how far the US has run, they're looking to maybe spread their bets around a little bit more. That said, the big test will be to what extent we see more cases like we did last year with the tariff situation where maybe US stocks sell off, but some of these international markets are more insulated from that. Because what you care about most, I would say, with adding these types of equity exposures is having meaningful diversification. Ideally something that doesn't sell off, so B doesn't sell off when A is selling off and vice versa. That downside protection is extremely valuable for your long-term returns, and if we see some divergence happening like we did last year, that's gonna be a strong recommendation for maybe thinking about these exposures that have historically not been such great bets.
Peter, real quickly, before we leave the slide, what does the long-term, the 04 to 24 Sharpe ratio look like of these three classes? And what would you have to believe about the next 5 to 10 years to really embrace allocating more capital to emerging markets?
I don't have the number off the top of my head, but just from looking, we have the return here, and the downdrafts gives you a sense of the relative volatility. So, the Sharpe ratios on these international markets is definitely going to look a lot worse going back over that historical period. I think, you're going to have to believe that we've had a bit of a regime shift, that the better valuations, maybe some geopolitical changes that have been happening lately, maybe changes in exchange rates, have created a setup where international equities have more room to do better on a relative basis, or at least to do differently and provide real diversification. I think that's the narrative that would really drive that choice. But the longer term historical data doesn't make much of a case for the international assets. That is all backward looking data, and John Schaefer would point out that's driving in the rearview mirror. But that's kind of the whole point here, how it looked one way for a long time, maybe it's starting to look different.
What do you have to believe emerging markets will do to overcome that? Ignoring the past, what do you have to believe? How much better do we have to get to say you can make a major directional shift in allocation in these equity broad geographical centers?
You mean in terms of like a narrative of growth, of capital inflows? Yeah. That's I feel like that could be a whole presentation on its own.
Yeah. That's the big question here. Is I've been a fan of these things. I've sat in funds and just watched them, and I've lived through this experience. I think you're right, but the catalyst hasn't been there because of the fundamental depth of the U.S. capital. I've had this discussion with Jamie, who you probably know his last name. That's my question. I think you're probably right, but how much do you have to believe to get there?
Yeah. Also, the level of your conviction is going to be tied to the level of your exposure. To add 5 to 10% to something because you think it's got a better story than it did in the past is different than putting 30% into something that you think is poised to take over the world. But that might be a great. No. Questions are welcome. That could be a great opportunity for a white paper coming up. Watch this space. All right. I have it on good authority. There's a great Ray Dalio quote about forecasting the future. The details of it escape me, but maybe someone in the audience has it in mind. Possible scenarios for where we go from here. with the equity landscape. Yes. Yes.
I was wondering, you were saying that the S&P obviously is not as diversified as it was before, and you're talking about these returns on the S&P. Do you have any feeling for what the return is if you pull out those three? Say you took an index of all the rest and pulled that out. Do you have any idea what that return would be?
That's a great question. I don't have the answer to off the top of my head. I feel like there's probably, that's a question where normally I would immediately pull out Claude and get an answer from there. I know there are equal weight indices that keep all the constituents at a constant 20 basis point allocation, and that gives you a pretty good sense of what that looks like without the huge overweight. And it's definitely a lot lower, most of the time.
Well, it just seems like, you've emphasized that all is overweighting.
Yeah.
And then I'm sitting there thinking, well, I'm really not interested for it in my company. I was just thinking about my own portfolio and what I've got in index funds, and I'm like, I'm going to rethink some of this, but that kind of.
Well, I'm not a salesman, but I think RSP is the ETF that does the equal weight S&P 500, and that actually is one reasonable thing to hold for people who are concerned about the concentration.
But
Yeah.
I was just curious if you knew what the.
Yeah, I don't off the top of my head. It is a good question. It is definitely lower. A huge amount of the index's gains have been driven by those few companies, and if you strip out their effect, there's a very noticeable difference. And that's not been always the case historically. I think if you look at a lot of prior years, if you took out the top 2, 3, 5 performers, it wouldn't have that huge an impact. But that's what you get with this kind of concentration. All right, so a bull case. The AI narrative is real and transformative, and above all, it's a high-margin business. The productivity revolution justifies elevated margins and maybe pushes them higher. Mega cap earnings continue to exceed expectations. NVIDIA continues to beat and raise for another decade. If the Fed delivers rate cuts, that also supports multiples. And in this scenario, maybe the last decade was not the anomaly. Maybe we've actually unlocked a higher plateau of productivity and profitability. Now, it's a completely made-up number, but I would give this maybe 15 to 20% for this scenario. Bear case is that margins mean revert towards historical norms. Maybe not all the way down to like 7%, but maybe 10 or 11%. That would still mean a material decline from where we are today. The concentration in these mega caps unwinds as it did after the dot-com peak. I'd remind you, from 2000 to 2010, US stocks returned essentially nothing. Add in maybe regulatory or antitrust action against some of these large companies, and you have a recipe for a difficult decade. Again, I would say this is probably no more than like a 20% likelihood. And a base case would be, and I would obviously put the higher probability here, the next decade's equity returns are positive, but below the recent past. Not a disaster, not 16%. Maybe on the order of 7% a year or so annualized, with some meaningful bouts of volatility along the way. Maybe even actual occasional entire calendar years with a negative print. In this environment, the right approach then is to add some diversification, consider how much exposure you want to have in these concentrated names, consider options that would perhaps improve your diversification, and size your allocation with drawdowns rather than anticipated returns in mind. Ultimately, if the bull case bears out, though, anything you do is probably going to succeed. If the bear case should occur, then having your equity sized with drawdowns in mind is going to be the most important thing. But with a base case like this, that's where strategic thought really comes into play, and that's kind of what we're going to be focusing on. So, getting practical. I would maintain that the single most important decision you make with respect to equity is in fact just how much of it you own. Not really what you buy, that does matter, but the big thing is just how much do you have, and particularly how much do you have relative, not to your size of your portfolio, but relative to your surplus. We can really break that out into 3 buckets that are shown here, and these are representative of the overall P&C industry. That's why we put these levels on them. Say 15% of surplus or less would be a light equity allocation. It's appropriate for companies with thinner surplus, maybe more volatile underwriting, or just a lower risk tolerance. You're going to get some return benefit, but it's not going to dramatically move the needle. Moderate would be, say, 15 to 35%. That's really the fat middle of the bell curve. This is where most reasonably well-capitalized P&C companies who hold equity wind up. This is enough to meaningfully contribute to your investment returns and your ROE, but it's also sized so that in a bad year, you're not creating a capital crisis. And then heavy would be basically anything above 35% of surplus. You see some companies in that 35 to 50 range, and then it really starts to get sparse. You get those occasional outliers who are like 70, 80, 90% of surplus. I want to say Berkshire's at like 100% or something, but they're doing their own thing. These are aggressive levels. This requires strong capitalization. Above all, this should involve an investment committee or a board that fully understands that they're making an aggressive allocation. The main thing is just make sure that you're ready to potentially take a 10 or 15% hit to surplus in a big equity sell-off. Talking about what a hit looks like, just thinking of historical stress tests. I mean, we look at statistical analyses of historical volatility and we calculate different standard deviations of returns, but you wind up with numbers that are very similar to just looking at what did equity do when sell-offs happened. Well, the Great Financial Crisis was a 47% peak to trough drawdown. In 2020, it was 34%. That included the largest 1-month decline ever for the index, which was immediately followed by the largest 12-month increase ever, so a real whipsaw there. In 2022, the inflation shock, covering about 9 months, that was about a 25% decline. That came with a simultaneous bond market rout, so you're really getting pressured from every direction. One point to note, just given everything I've said about concentration here, the NASDAQ, obviously very tech-heavy, when the tech bubble burst, the NASDAQ ultimately fell about 80% peak to trough. Now, those businesses were much less sound than the ones that we're concentrated in today, but it does kind of show when a sector falls heavily out of favor rapidly, what can happen with that. So I think the exercise everyone should do when thinking about your equity allocation, this is certainly something that we do when we're working with you, is think about your equity sizing and apply, say, like a 30 to 40% drawdown to that. Look at what happens to your surplus, look what happens to your key ratios, your RBC ratio, and see what your comfort level is with that. The name of the game is to not have to sell at the bottom. It's to be able to ride through the volatility, participate in the recovery on the other side. And that's how you get a nice, healthy, long-term return. Yes?
How do you model or account for the fact that over time, it always goes up again?
I mean, that's a great question. And that's kind of exactly what I'm saying. Like, we believe in the long-term potential of equity. I mean, as we've modeled out an asset allocation, we're going to reflect the fact that equity is going to have a higher long-term expected return. What we're trying to do is avoid having a client be in a position where an interim loss has put them in a position where they can no longer tolerate further volatility and they need to exit that position. Just being able to stay in the market with a long-term strategic allocation, that's, over time, that's going to deliver the returns that people are looking for. If that answers your question. All right, and you gotta bear in mind too, I mean, the risk-based capital charge on equity for P&C companies is 15%. That is a lot more than we're getting charged on bonds. So again, you want to make sure that you're getting paid for taking on that risk, both in terms of volatility of surplus and the RBC. So talking a little bit about how equity is held, what kinds of vehicles. There's really two main options here, though you can also do a hybrid of the two, and many companies do. We'll talk here about exchange-traded funds and then separately managed accounts, and ETFs and SMAs. ETFs are workhorses. They give you, fees are typically very low, usually below 10 basis points. Some of the big ones, it might just be 2 or 3 basis points. These are some of the cheapest investment funds you can own. These give you clean, efficient exposure to an index or a sector. It's a single line item on Schedule D. They can rebalance internally by exchanging baskets of shares, or baskets of the shares they hold for new shares of the ETF, which means they don't have to create taxable gains within the fund when they need to rebalance. That and their daily liquidity is a big part of why they've been rapidly displacing mutual funds over the years. If there's a big downside they have, one would be that you have a limited ability to tactically realize gains or losses if you want one or the other. If you only have a handful of ETF positions and they're all at gains, you can't really squeeze a loss out of that anywhere. And because these do track indexes, they are exposed to like what we're seeing now, this concentration issue. Separately managed accounts have kind of an opposite set of trade-offs. Probably the biggest advantage they have is a lot of customization potential. If you or your investment manager has a strong conviction about either a strategy that you believe is going to outperform the broader market, if you have something like an ESG or values-based screen that you want applied, if you're concerned about concentration and you say, we want to have a much more granular portfolio, we want, this max per issuer, we want this max per sector, these can all be handled in a straightforward way within an SMA. The downsides are that fees are typically going to be materially higher. You'll need to rebalance, especially if you're setting limits on your exposures, and that can potentially trigger taxable gains that you may or may not want. And ultimately, if you have a need for liquidity, you might find yourself needing to sell dozens of positions instead of a single line item, and that might disrupt how the portfolio is balanced and require additional trading to get it back to a more balanced state. There's really not a one-size-fits-all recommendation here. Both of these approaches have pros and cons, and again, often companies will have some degree of mix of the two. Both are very widely used by the industry. Bottom line is ETFs are nice for simplicity, convenience, and low cost. SMAs are nice for customization for those who have a lot of conviction in some strategy whose performance characteristics they like, or if you're looking to potentially have that ability to tactically realize gains and losses within the portfolio for tax needs. I've mentioned this a bunch of times. This shows you just how extreme concentration risk has gotten in the market. Top 10 companies in the S&P having been relatively stable, 20 to 25% for decades, until all of a sudden we're at like twice that level today. But really the question is, what do we do about this? Well, the first point I should make, and I mentioned this before, some may actually be comfortable with this, again, taking a passive exposure, thinking that these companies have done well, perhaps they'll continue to do well. I'm here to get the market return, not to try to adjust things up or down. And that's fine, as long as they understand the concentration risk that's developed. But here are some things you can do if you think that the relative lack of diversification that has emerged in passive indexes is a concern that you would like to mitigate. First, and maybe simplest, is to shift some exposure to either more of a dividend value tilt, an index that's still broad, but that maybe does not have the exposure to those Mag 7 names. Interestingly, some of these dividend funds have actually done extremely well year to date because they tend to be a bit more focused on things like energy that's also been having a great year. I forget who had the chart the other day of like the top performing sectors year to date, but obviously energy is in the top like 2 or so. Ultimately, an equal weight fund, like we mentioned earlier. That can be a way to get back to having like a truly diversified exposure that remains agnostic. You're not overweighting or underweighting anything. You're just saying, I want the returns of all the companies, and that helps to balance things out. You don't have to shift an entire portfolio over into these things, but just perhaps adding some at the margin or like a partial adjustment can help to take some of the extremity off of the concentration in a portfolio. Another option, we were talking about international exposure, how it does seem to have growing momentum, and it may be the case that there is an opportunity there to have a different set of exposures, different geographies, often different industries than what the US is concentrated in. That's starting to look much more interesting than it's been in a long time. Admittedly, certain specific international geographies are also very levered to the AI trade, focused on things more like semiconductors or memory production, but there's also a lot else going on in many economies there too. Third, you were hearing a little earlier about convertible bonds. If you're concerned about the downside potential that equity concentration potentially creates, then convertible bonds, an asset that has a bond floor that helps to limit downside potential, could be one way to mitigate that while still having baseline equity exposure. It also has a nice RBC treatment, which can be also helpful for life companies who maybe want a little bit of equity exposure and are able to manage the ALM implications. Fourth, uncorrelated private assets, whether that would be direct lending or some of the mortgage strategies we heard about. That's part of the whole sales pitch with these private assets is they're meant to be uncorrelated. These are not the same companies that are trading in public equity markets, And again, if you have something where it's not gonna zig at the same time the rest of the market zags, then again, that helps you to have your overall portfolio return smoothed out and reduce some of the downside potential in the big picture. And ultimately, this would be a bit more extreme step, but I could see some reason for considering it, is look at your investment guidelines and where they talk about equity, and consider if you want to maybe add a feature to that you're going to have probably already a per issuer limit, but do you want to consider having a per sector limit? If you have, you say we can have up to 25% in equity, but half of that is tech. Is that the goal of your equity strategy? Because that's where things are starting to drift. So you could go so far as to require sector limits. And with the data available about the contents in ETFs these days, it's easier to manage that and make sure that those limits are being respected. So I have one more strategy topic, and it's a very important one. So here's the thing. The S&P 500, we were saying, has returned about 16% a year over these last 6 or so years. If you set a target equity allocation towards the start of that period and you haven't rebalanced, you are probably now significantly above that target. I've seen companies have like a 20% target that are actually sitting now at like 28 or 30% exposure because they let it ride. And I understand that temptation. I mean, frankly, that's worked out great. And why would you stop doing that? Ultimately, though, risk management is frankly, it can feel a lot like having to eat your broccoli. It's not the most euphoric thing in the moment, but over the long term, it's what does you the most good. Rebalancing creates a natural buy low, sell high discipline. You're trimming your equity after it's run up, and you add more to it if it's had a sell-off. It's not market timing, it's a form of mechanical risk control. I think, and I want to really emphasize, I think one thing that's actually really helpful about it is there can always be a psychological temptation, either when you see your portfolio running up a lot, to be like, should I sell? Should I take the chips off? Should I do some kind of an active move? And vice versa, when it's selling off, it's like, oh my gosh, I will either, is this a buying opportunity? Do I want to dive in and chase this? Or like, do I need to get out of the market? If you know you have a clear rebalancing program in place, it's going to do those things for you, and you already have known rules and set intervals where those things can happen, and you don't have to have the stress of trying to make a decision ad hoc in what might be a charged moment. So just psychologically, it can be a very, very comforting thing to already have in place. What we recommend for that is, it's a calendar approach with tolerance bands applied. You pick a time period, maybe it's annually, maybe it's semi-annually, you can do however, it depends however active you want to be about it. And you have an equity target level that can be percent of your portfolio, it can be percent of surplus. And you say that at the measurement date, if my exposure is more than X percent away from its target, I'm going to rebalance it back to the target. If it's within the band, it's fine, I'll leave it, I'll let it run. You don't need to be rebalancing every 1 or 2% move. But if it's had a material shift away and now it's more or less risk than we're trying to have on the balance sheet, you move it back. This has a few advantages for balancing the ability to let it ride with the ability to actually control risk effectively. It means that you're not always having to do something if the market hasn't really moved that much. It's just a pretty balanced approach overall. One thing to bear in mind too, if you do rebalance, if you find yourself in a need to do that, but you're worried about the tax bill, interest rates remain pretty high. Insurers usually still have unrealized losses on bonds. You can offset those two for tax purposes, and on the bond side, you can reinvest at higher rates and increase your book yield. This is something we've done for a number of our clients, and it's worked out well so far, and that opportunity is still very much alive. The one thing to be aware of is that that does cause some decline in surplus coming through on the realized losses on bonds. Since your equity gains are already in surplus, they don't get realized when you sell. But overall, this can be, it saves you tax dollars, it's a real economic benefit, and it can set you up for stronger long-term returns as well. So, wrapping up with key takeaways. First is that the S&P 500 is not what it used to be. It's got concentration that's effectively never been seen before in living memory, and a passive index fund is no longer a guaranteed source of ready diversification. It's just important to understand what you actually own in those exposures. 2 is to diversify within equity and your overall portfolio. Now, you would never think it to look at me, but investment strategy can actually often be rote and boring and unglamorous. And really simple things like diversify and rebalance in a disciplined way over a long period of time are the things that actually lead to healthy performance, healthy risk management, and durable returns over time. We had the general speak to us yesterday. He did a great speech, and it was a military idiom. It's something like amateurs talk tactics, experts talk strategy, pros talk logistics. And I think there's something analogous with equity investing where it's like amateurs talk meme stocks, experts talk valuation ratios, and pros talk diversification and rebalancing. It sounds simple, but it's critical. Third point, size to your surplus, not to hopes and dreams of the market continuing to do what it's been doing in recent years ad infinitum. Stress test your equity allocation. Expect that a 30 or 40% drawdown will come sooner or later, and just see what your balance sheet is going to look like at that point, so that you're ready to ride it out, because sooner or later it will recover in the wake of that. 4, use the right vehicle for your goals and objectives. ETFs and SMAs can both be excellent tools. They kind of solve different problems. Just be intentional about why you're using the one you're using. Then 5, rebalancing is not optional. After years of really strong returns, drift is real, and it can be dangerous from a risk management perspective. I'm sure there are shops who believe in that and have their case for that, and I think I would look primarily to the more tangible potential benefits there, where it's like tax loss harvesting, or if you want to do like an ESG screen, the customization. Those are things you have in hand. If you're kind of just like, I want to have equity exposure, then having a few ETFs over time is probably going to be very close from a performance perspective anyway, unless you've got someone who's doing something really wild with an SMA with just 8 positions or something, and they're a genius. But yes.
Well, you've made the point that the S&P has changed, and it's not what it used to be. But yet, from my experience, companies still want to use that as a benchmark. Is that your experience? Do you have any thoughts on how to segue them away from it?
I mean, the benchmark, the S&P 500 obviously has tremendous kind of prestige as the definitive U.S. equity benchmark, and it includes 80 or 90+% of the total U.S. equity market, really just X a little bit of small caps. I could see the argument being that the goal with a benchmark is to accurately reflect the return, to accurately and passively reflect the return of a broad market, so that you could identify if a company is able to add value beyond what you could get by merely passively following the market. I think I would look primarily to the more tangible potential benefits there, where it's like tax loss harvesting, or if you want to do like an ESG screen, the customization. Those are things you have in hand. If you're kind of just like, I want to have equity exposure, then having a few ETFs over time is probably going to be very close from a performance perspective anyway, unless you've got someone who's doing something really wild with an SMA with just 8 positions or something, and they're a genius. But yes. The benchmark, the S&P 500 obviously has tremendous kind of prestige as the definitive U.S. equity benchmark, and it includes 80 or 90+% of the total U.S. equity market, really just X a little bit of small caps. I could see the argument being that the goal with a benchmark is to accurately reflect the return, to accurately and passively reflect the return of a broad market, so that you could identify if a company is able to add value beyond what you could get by merely passively following the market. If you want to avoid having that level of concentration, and you have someone who is maybe actively managing equity, you could say, like, we don't want you to be that concentrated as the overall index. We're gonna have a different index for you, maybe different sector weightings, maybe equal weightings. That's what we want you to be targeting, specifically because we want you to avoid the concentration. But if it's kind of just a broad go anywhere equity mandate, then there is a fair point to be made that, like, looking at the market as a whole and what the market return delivers, even if it's concentrated, is like a proper measurement against that. I mean, if anything, I think a lot of active managers have been wary of not having adequate exposure to these big names because they've been such huge drivers of returns. But one day that dynamic will reverse too. All right, well, thank you.